you may be familiar with what the market model looks like, the demand and supply model. But how do we incorporate a tax on the activity into that demand and supply model? And if we can do so, we can see how a tax will affect the price, the quantity, and the welfare in a market. Can a tax on a producer be passed on to the consumer? That's one of the questions we'll be able to answer in this section. So here's the example that we will look at. There's been a lot of talk recently about trying to reduce the amount of sugar in diets, especially in young children. And there's consideration in various countries of putting a tax on sugary drinks. Let us use that as our example. So here is a market. We have our demand and supply curves. And in the absence of any interference in the market, we have an equilibrium price in the market of $100. In the absence of a tax, a market only has one price. That is to say that the price being paid by the buyer is identical to that received by the seller. What a tax does is it causes those two prices to diverge by the amount of the tax. The amount that buyers are going to pay is going to be different than the amount that sellers are going to ultimately receive. And the difference is the amount of the tax. So to implement a tax in this model, on this diagram, we want to ask the question, where is quantity demanded and quantity supplied equal such that there is a gap between what the buyer pays and the seller receives by the amount of the tax? Let us say we're going to impose a $50 tax in this market. Where is it that quantity demand and quantity supplied would be equal such that there's a $50 gap between what the buyer pays and what the seller receives? Well, what we are trying to find, to reword the question, is what is the quantity for which the height of the demand curve is $50 greater than the height of the supply curve? So let's measure $50. There it is, because our vertical axis is a ruler of various prices. Take that amount and simply search for where the difference between the two curves is exactly $50. And there it is. That's the tax. And there is the quantity we seek. That is the quantity for which what buyers are willing to pay is exactly $50 greater than what sellers are prepared to receive. That's what the buyer pays. That's what the seller receives. In this example, the buyers pay $135 and the sellers receive $85 per bottle. Then this market will clear. Quantity demanded will be equal to quantity supplied. Since the original price was $100 a bottle, then we can work out that the buyer's share of the tax is $35. The buyers are paying $35 more than they were paying before the tax was implemented. And the sellers are receiving $15 less. So the burden of the tax has been divided between the demand side and the supply side of the market. And in this present instance, the buyers are bearing the larger share of the burden of the tax. $35 to the sellers, $15. So we have worked out that if a $50 tax is put on this market, the market for drinks that have sugar in them, if a $50 tax is put on this market, we have worked out what share of the burden of the tax is being borne by the demand side versus the supply side. What is astonishing about this conclusion is that we have not bothered to specify which side of the market is being taxed. We have not specified whether the producer is being taxed or the consumer is being taxed. The consumer can be taxed by means of a value-added tax, by means of a value-added tax, like a consumption tax, such that, you know, when you go into the shop, you will see one price on the product, but when you take it to the cashier asks you to pay an additional amount representing the consumption tax. Alternatively, this tax could be levied directly on the producer. So as the producer produces it and ships it off for sale, he has to remit the tax to the government. So both of those are different ways of taxing this activity of producing and consuming drinks. And without specifying whether the producer or the consumer is being taxed, we have worked out who is bearing the incidence of the tax. Which brings us to the astonishing conclusion that the incidence of a tax is independent of the target of the tax, is independent of which side of the market is the target of the tax, is obligated to remit the tax to the authorities. This is an astonishing conclusion, and one that is not intuitive. Now that we have that conclusion as our basis, let us demonstrate it again, because it's such an important conclusion. Let us demonstrate it by actually taxing one or the other side of the market and seeing that we get the same result. First, suppose we are taxing the producer. For every bottle produced and shipped off by the producer, he has to remit $50 to the government. This has the effect of raising the cost of production by $50. So we shift the supply curve upwards by exactly $50. The producer's willingness to supply has not changed. So we can say the producer supply curve is the same, but the market supply curve, the price at which the market, let us say, needs to be compensated for each quantity, is $50 higher. So we show it by shifting the supply curve upwards by the amount of $50. Given that new market supply curve and the existing demand curve, the market clears at $135. That is the sticker price that will be on the bottle. But when the sellers receive that $135, they have to take $50 of it and remit to the government, and so they only receive $85. This is the result we derived before. Buyers pay $135, sellers get to keep only $85. Even though they receive $135, they get to keep only $85. So we get the same outcome as we did in the previous exercise if we explicitly tax the producer. The burden of the tax, $35 is borne by the consumer, $15 is borne by the producer. Now let's take that same market and instead levy a value-added tax, a consumption tax on the consumer. The consumer's willingness to pay for each quantity remains unchanged. But what market participants receive is going to be $50 less. So we show this by shifting the market demand curve downwards by $50. In that scenario, the new market demand curve and the existing supply curve cross at $85. That will be the sticker price on the product. But when a consumer takes it from the shelf and arrives at the cashier is going to say, give me $135. $85 for the product, $50 for the consumption tax. So again, the consumer ends up paying $135. The producer receives $85. And the burden of the tax is split exactly as was the case when we taxed the producer. The only difference is what is the price on the sticker for the product on the shelf. But what consumers end up paying and what suppliers end up receiving is the same no matter which side of the market is taxed. So whether the supplier or the buyer is taxed determines only the price on the sticker, but does not affect what is paid or received. This does raise an interesting question, though. If the side of the market taxed does not ultimately, once the market is allowed to clear, determine the burden of the tax, the incidence of the tax, then what is it that determines that? It's the relative slopes of the demand and supply curves. Here, in this example, we see the buyers bearing the larger share of the burden of the tax because we happen to have drawn our demand curve to be steeper than the supply curve. If I were to change the relative slopes of the two curves, make the demand curve shallower and the supply curve steeper, you will see the incidence of the tax shift accordingly. As the supply curve gets relatively steeper, suppliers end up bearing the larger share of the burden of the tax. So the incidence of the tax is determined by the characteristics of the market and not by the party upon whom the tax is actually levied. Which allows us to answer one of the questions that we posed earlier. Can suppliers always just pass on the tax to consumers? Well, no, because if the demand curve is relatively flat compared to the supply curve and a tax is imposed on suppliers, the supply curve shifts upwards vertically by the amount of the tax. Because it doesn't matter which side of the market is taxed, the buyers don't bear a larger share of this burden. we see the buyer's share of this tax is actually quite small. Suppliers are unable to pass on the cost of the tax if the demand curve is flat. The demand curve being flat signals that consumers are actually not willing, many consumers are not willing to pay a much higher price. So as the price goes up because of the tax, buyers flee the market. And therefore, buyers end up bearing only a small share of the burden of the tax. One way of putting this is to say that consumers will only accept the tax being passed on if they are so willing. Suppliers cannot pass on the tax unless consumers agree to it, unless consumers are actually willing to pay the higher price without reducing their quantity of consumption. In this diagram, they are not so willing. They reduce the quantity of their consumption and the attempt to pass on the cost fails. So, can a tax be passed on? If the demand curve is relatively flat, then the answer is no. The buyers would rather flee than to pay the higher price. This is one of those results. The result that the incidence of the tax is independent of the target of the tax. This is one of those results that is so unintuitive. Nobody who has not done a course in economics understands this. Indeed, governments and citizens around the world get themselves into a kerfluffle, trying to argue which side of a market should be taxed. I did a quick search on the internet for social security taxes, which is a favorite tax of governments. You tax the labor market in order to fund the country's social security system. And in nearly every country, that tax is split between what share of it employees pay and what share of it employers pay. And here we see a range of countries that I picked randomly from what I found. A lot of effort goes into making sure that both employees and employers split the tax. And as we can see from the data, the sentiment is usually, or is often enough, that employees should pay a smaller share. But the point is, the effort is meaningless. Once the labor market gets a chance to adjust to a new equilibrium, the incidence of the tax is independent of this split of which side the tax is levied on. It's all wasted effort on the part of governments. So, economists, from one perspective, don't much like taxes, but not for the same reasons that you don't like them. You don't like them because you have to pay them. Economists are wary of taxes for a different reason. Economists want taxes to be only as high as is necessary to fund the operations of an efficient government and not a dollar more. We're going to use welfare analysis to explain this. We know that in a market, consumer surplus is the area above price and below the demand curve, and producer surplus is the area below price and above the supply curve. When a tax is levied on a market, the quantity that is traded falls and consumer surplus shrinks. Consumer surplus shrinks both because there's a smaller quantity and consumers are paying a higher price. Producer surplus also shrinks both because there's a smaller quantity and because producers are receiving a lower price. But we now add a new element of welfare, which is government revenue. Government revenue is the quantity traded, which is the width, multiplied by the price, multiplied by the amount of the tax, which is the height. And so that gray area represents total government revenue. And total government revenue represents the welfare, the amount of welfare that accrues to the government. So total welfare in the market after the tax is levied is the sum of all three of those areas. Now, note that total welfare after the tax is levied is less than total welfare in the absence of the tax. And it is less by the amount of that area. That is called deadweight loss. The net loss of welfare that results from the imposition of the tax. What has happened here is that some of the consumer surplus is not lost to the economy as a whole, it is merely transferred to the government. And since the government is there to spend on public services, it ultimately redounds back to the benefit of the citizenry. So a tax is a transfer from consumers to the government, and therefore is not a net loss of welfare. To the extent that producers share some of the burden of the tax, then it is also a transfer from producers to government and is not a net loss of welfare either. A transfer from one person, one entity to another is a loss for the entity paying, but a benefit for the entity received of exactly the same amount. What has happened here, though, is that some of the lost consumer surplus and some of the lost producer surplus, the deadweight loss area, is a net loss to the economy as a whole. And that's why it's called a deadweight loss. So the problem with taxation is not that consumers or producers have to pay it, because when it goes to the government, that ultimately redounds to the benefit of the public. The problem with taxation is that it creates deadweight losses. And it creates deadweight losses because the quantity traded in the market is less than would have obtained at the equilibrium. Potentially welfare creating trades do not take place. Taxes create deadweight losses. Our major takeaway from this is the truly astonishing result that the incidence of a tax is independent of the entity upon which it is levied.